Let me ask you something. When was the last time your savings account made you feel wealthy? If you're like most people, you're earning maybe 4 or 5% while watching inflation silently eat away at your purchasing power. For retirees and income investors, this is more than frustrating. It's genuinely concerning. You've worked decades to build your nest egg, and now you need it to work for you. But here's the reality. Traditional savings aren't cutting it anymore. Today, I'm going to show you 3 exchange-traded funds that are paying between 8 and 12% annually, with monthly distributions hitting your account like clockwork. And before you think this sounds too good to be true, everything I'm sharing today is verified. Current data as of November 2025. By the end of this video, you'll understand which of these 3 income machines fits your personal risk tolerance and financial goals. Quick favor, hit like and subscribe right now so YouTube shows this to more people who need to see it. So why does an 8% yield matter so much right now? Think about it this way. If you have $100,000 in a traditional savings account earning 4%, you're making $4,000 per year. That's $333 monthly. Now imagine doubling or even tripling that income without taking crazy risks. That's the power of strategic dividend investing. But here's what I want to be crystal clear about. We're not chasing yield for yield's sake. We're not gambling on penny stocks or sketchy REITs that could collapse tomorrow. We're looking at 3 distinct proven strategies: equity premium income, covered call writing, and global dividend hunting. This isn't about getting rich overnight. This is about building reliable, sustainable monthly income that you can actually count on. Let's start with the conservative champion, JEPI, the JP Morgan Equity Premium Income ETF. This fund manages a staggering $40.72 billion in assets, making it one of the largest income-focused ETFs in existence. Why does size matter? Because it means institutional investors, pension funds, and sophisticated money managers trust this vehicle with serious capital. Now, JEPI yields 8.37%. At current prices around $56.28 per share, it's paying about $4.72 annually per share. That translates to roughly 34 cents monthly. The November 3rd distribution was exactly 34.636 cents. Here's what makes JEPI special. It only charges 0.35% in expenses. That's incredibly low for an actively managed income strategy. After fees, you're keeping 8.02%. Compare that to actively managed mutual funds charging 1% or more, and you quickly see why JEPI has attracted so much capital. But what are you actually buying when you purchase JEPI? You're getting a diversified portfolio of America's finest companies. The top 10 holdings read like a who's who of corporate excellence. AbbVie at 1.68%, Alphabet at 1.63%, Microsoft at 1.59%, Amazon at 1.59%, Johnson & Johnson at 1.58%, Nvidia at 1.55%, Apple at 1.50%, NextEra Energy at 1.49%, MasterCard at 1.49%, and Howmet Aerospace at 1.49%. Notice something. No single holding dominates. The largest position is less than 2%. That's intentional diversification protecting you from any single company imploding. The sector allocation reinforces this balanced approach. 18.4% information technology, 16.4% finance, 14.2% industrials, 13.28% electronic technology, 11.81% health technology. You're not betting everything on one sector's success. Now let's talk performance expectations. JEPI returned between 4.16 and 4.37% over the past year. The year-to-date return for 2025 sits around 0.43%. Looking back 5 years, you're seeing 11.45% annualized. These aren't explosive returns. And that's precisely the point. JEPI is designed for investors who prioritize income stability over capital appreciation fireworks. If you're recently retired, living off your portfolio, or simply want to sleep well at night knowing your monthly income won't vanish, JEPI delivers. You're trading the possibility of massive gains for the certainty of consistent income. For conservative investors who've already accumulated wealth and now need to preserve it while generating cash flow, JEPI represents the gold standard. Now let's shift gears dramatically. Meet QYLD, the Global X Nasdaq 100 Covered Call ETF. This fund yields between 11.94% and 12.67%. Read that again, nearly 13% annual yield. At $17.44 per share, it's distributing $2.21 annually. The October distribution was 17.31 cents. QYLD has paid monthly distributions for 12 consecutive years without interruption. The expense ratio sits at 0.60%, higher than JEPI, but still reasonable given the active option strategy involved. After expenses, your net yield lands between 11.34% and 12.07%. Here's how QYLD achieves these spectacular yields. Covered call writing. The fund owns all 100 stocks in the NASDAQ 100 index, then systematically sells call options against those holdings. When you sell a call option, you're agreeing to potentially sell your stock at a predetermined price in exchange for immediate premium income. That premium becomes the outsized dividend you receive. The trade-off? If the underlying stocks skyrocket, your gains are capped because you've sold away that upside. You're essentially saying, I'll take guaranteed income today instead of hoping for massive price appreciation tomorrow. For investors prioritizing current cash flow over future growth potential, this can be absolutely brilliant. Looking at QYLD's portfolio, concentration is the name of the game. NVIDIA comprises 10.01% of assets. Apple sits at 8.76%. Microsoft holds 8.32%. Broadcom takes 5.88%. Amazon captures 5.48%. The top 10 holdings represent well over half the portfolio. Sector-wise, information technology dominates at 53.3%, communication services adds 16.7%. Consumer discretionary contributes 12.6%. You're essentially making a concentrated bet on big tech continuing to generate profits while accepting capped upside through the covered call overlay. Performance-wise, QYLD delivered 7.18% over the past year and 7.80% over 5 years. The year-to-date return for 2025 runs around 5.5%. Compare these numbers to JEPI's more modest figures, and you see the strategic difference. QYLD is generating higher income but potentially sacrificing capital appreciation. During raging bull markets where tech stocks double or triple, QYLD holders collect their dividends but watch from the sidelines as their call options cap gains. During flat or declining markets, those option premiums provide cushioning income that helps offset losses. Who is QYLD perfect for? Aggressive income seekers who fully understand their trading upside potential for immediate cash flow. If you need maximum income right now and can accept volatility in the underlying share price, QYLD might be your answer. Now for the surprise performer, SDIV, the Global X Super Dividend ETF. This fund combines income and growth in a unique global package. Yielding between 9.73% and 10%, SDIV pays around $2.32 annually from its current price of $24.20. The November distribution clocked in at 19 cents. SDIV charges 0.58% in expenses, leaving you with a net yield between 9.15% and 9.42%. But here's the shocking part. SDIV has delivered approximately 24% year-to-date returns in 2025. Over the past year, it's up 12.59%. Even the 5-year return of 4.67% looks respectable. SDIV has paid monthly dividends for 14 consecutive years. What makes SDIV so different? Geography and sector focus. This fund manages $1.04 billion across 100 holdings in over 20 countries. You're not investing in America. You're investing in the world. 20% of assets sit in Brazil, 8% in Norway, 6% in Israel, 5% in the United Kingdom, 5% in Italy, only 4% in the United States, 52% spreads across other nations. The top holdings reflect this global approach. D'Amico International Shipping from Italy at 1.86%, Direcional Engenharia from Brazil at 1.74%, MBRF Global Foods from Brazil at 1.63%, Banco Bradesco from Brazil at 1.61%, Ithaca Energy from the UK at 1.59%. These aren't household names. They're regional champions in their respective markets, offering compelling valuations and generous dividend policies, often overlooked by US-focused investors. Sector allocation tells another story. 27.9% sits in financials, largely driven by those Brazilian banks and insurance companies. 22.8% targets energy, capturing Norwegian oil producers and UK petroleum firms. 13% focuses on real estate. 11.1% allocates to materials. Consumer discretionary takes 9.1%. You're getting exposure to commodities, emerging market growth, and sectors that often move independently from US tech dominance. The smaller $1.04 billion asset base means more volatility, but potentially more upside as hidden gems get discovered. SDIV suits investors seeking income plus growth who feel comfortable with international exposure and currency fluctuations. If you understand that emerging markets can be bumpy but offer tremendous long-term potential, SDIV provides that diversification while still paying you monthly. So how do you choose between these three income titans? Let's compare directly. Yield-wise, QYLD wins at 12% plus, but remember what you're sacrificing. SDIV offers 9.73 to 10% with better total return prospects. JEPI provides 8.37% with maximum stability. After expenses, QYLD nets 11.34 to 12.07%. SDIV nets 9.15 to 9.42%. JEPI nets 8.02%. Assets under management tell a story about investor confidence. JEPI's 40.72 billion dwarfs, QYLD's 7.93 billion, and SDIV's 1.04 billion. Performance year-to-date shows SDIV crushing it at 24%. QYLD middle ground at 5.5%, and JEPI conservative at 0.43%. Think of it as a risk spectrum. JEPI sits on the conservative end. Lower yield, higher stability, blue chip quality. SDIV occupies the moderate middle. Solid yield. International diversification. Growth potential. QYLD anchors the aggressive end. Maximum income. Capped upside. Tech concentration. Here's an unconventional thought. Why choose just one? Portfolio diversification applies to dividend ETFs too. A conservative portfolio might allocate 70% to JEPI for stability, 20% to SDIV for growth exposure, and 10% to QYLD for yield boost. A balanced approach could split 40% JEPI, 30% SDIV, 30% QYLD. An aggressive income portfolio might do 30% JEPI, 30% SDIV, and 40% QYLD for maximum cash flow. Let's make this tangible with real numbers. Invest $10,000 in JEPI at 8%. You're generating roughly $800 annually or $66 monthly. That same $10,000 in QYLD at 12% produces $1,200 annually or $100 monthly. In SDV at 10%, you're making $1,000 yearly or $83 monthly. Scale this to $50,000. JEPI generates $4,000 annually or $333 monthly. QYLD produces $6,000 annually or $500 monthly. SDIV yields $5,000 annually or $416 monthly. At $100,000, JEPI pays $8,000 annually or $666 monthly. QYLD delivers $12,000 annually or $1,000 monthly. SDIV provides $10,000 annually or $833 monthly. Here's what you need to understand clearly. Past performance never guarantees future results. Dividends aren't guaranteed. They can be cut, suspended, or eliminated based on market conditions and fund performance. These are investment vehicles with real risk. But compared to chasing speculative stocks or gambling on cryptocurrencies, these three ETFs represent institutional-grade strategies managed by major financial firms with transparent holdings and decade-long track records. You're not discovering some secret loophole. You're accessing sophisticated income strategies previously available only to institutional investors. So, what should you do next? First, research each fund thoroughly using their official websites and prospectuses. Second, consider consulting a financial advisor who understands your complete financial picture, not just what I've shared in 10 minutes. Third, if you decide to invest, start with smaller positions. You don't need to commit your entire portfolio on day one. Test the waters, watch the monthly distributions arrive, and see how you feel about the volatility and performance. Fourth, remember that dividend investing is a marathon, not a sprint. Monthly compounding and reinvestment can dramatically accelerate wealth building over years and decades. The bottom line is this: 8% plus yields are absolutely available without gambling. JEPI offers conservative income from America's finest companies. QYLD delivers aggressive cash flow by trading upside for premium income. SDIV combines global diversification with growth potential alongside substantial yields. Each serves a different purpose for different investors at different life stages. The question isn't which one is best universally. The question is, which one aligns with your goals, risk tolerance, and income needs? If this video helped clarify your options, hit that like button and subscribe for more income investing strategies. Drop a comment telling me which of these 3 ETFs interests you most, and why. Are you Team JEPI for stability, Team QYLD for maximum income, or Team SDIV for global growth? Let's discuss in the comments. Until next time, invest wisely and let your money work as hard as you did to earn it.